this ratio became too low. It was too low. So there are two things you can do, right? You can either try and boost, if you want to bring it back up, you can either try and boost your equity, issue stock, but nobody was willing to buy stock from banks. The other thing that you can do to boost this ratio is to do what? Sell assets. So the perverse thing that happened was that when banks were faced with these big losses and they had to take big write-offs, they were forced to sell the assets that had taken a huge hit in the market already. So now the market was being flooded, right, with all these crappy investments. Doing what to the price of these investments?
Driving them down further.
Driving them down even further, right? So that's when a lot of people in the financial industry started blaming the accountants. They said, look, you're forcing us to sell these investments because of mark-to-market accounting. That's resulting in a price decrease of these investments that we believe is just not justified by our long-term expectations of how these investments are going to pay off. That incurs them further losses, and so it became this vicious cycle, right? They had to take the write-downs, so they had to sell more assets because they couldn't raise equity. That will cause the price to drop even further, and so they blamed the accountants. They said it's your fault, right? The market may have overreacted at that time. Sure, it did. But is that the accountant's thing to worry about? I don't think so. The accountant is the messenger. I mean, I think it was a classic case of shoot the messenger, right? The accountants are telling us that our investments are really crappy, and so they're getting us into trouble. No. The investments that you make were really crappy. But I want you to understand that fair value accounting was something that was very broadly discussed by people in the industry as being the main culprit for this. Right? And the logic is there. All right. So that was debt securities. Investments in equity securities is a lot easier because we don't have to account for interest revenue. So we don't have to amortize anything. The only revenue that we might have to account for on equity investments is, of course, dividend revenue, right? If we receive dividend. Now, if we own more than 20% of a company's stock, we can use the equity method, and if we own more than 50%, we need to consolidate. So let's not worry about that. So most of the investments that we're going to be talking about here are investments in equity securities less than 20%. All right, let's just look at an example, and we can figure out the accounting from there. On October 7, 2004, Raptor purchased common stock of 3 companies. Each investment less than 20%, classified as available for sale. All right. First investment. So to report this investment, which has a cost of $143,710, of course we just simply debit AFS Securities. Credit cash. What do you amount of the investment? Oops. Oh, that's the button. Why is it so yellow? Something. Isn't it like that, right? Oh, there's a light there. Look at that. Is this the first time I'm turning this on?
Oh, you forgot to turn it on this week.
I see. All right. Nice. All right, so no interest to worry about, but cash dividends, right? So on December 6th, you receive a cash dividend. What's the journal entry there?
Debit cash.
Debit cash. Credit. Dividend income. Dividend revenue. Right? That's just on the income statement. $840. Easy enough. All right, here another example of a fair value adjustment. the end of the year, portfolio had the following fair values. 136.6. Remember, cost was 143.710. And so the journal entry that we prepare, what's the amount here? The securities fair value adjustment account needs to have what kind of a balance?
7110.
Debit or credit?
143 to 136, so it would be a debit. No, credit.
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 Yeah, credit balance, right? Because cost is higher than the market value, we need to write it down. 7110 credit.
Okay.
So we credit securities fair value adjustment account for available sale securities for 7110, and we debit the unrealized holding gain or loss account, which is in equity because we're talking about available sale securities for 7110 as well. Then, on January 29th, 2005, Rapid sells all of its Ford Motor Stock Company, receiving $57,444. It says net proceeds here. The way it works, if you sell an investment and the investment bank is charging you $200, it's just considered a decrease in the cash that you receive. Okay, it's not booked as an expense. It's just less money that you get. Okay, so if you really sold this for $58,000, but they're subtracting $556 here, you just accounted for this. I'm only getting this. All right, so we debit cash for $57,444, and obviously we're going to credit available sales securities for how much though? For how much are we going to credit it for? The 55 or the 51,940?
So, the original purchase.
The original price, right, Song? Because look, when you made the adjustment down here, you did not adjust available for sale securities account itself, right? That was only booked for cost. That account was never changed. So when you're going to credit available sales securities here, you do that for the cost of $51,940. Now, of course, that raises the question, hey, this unrealized holding gain or loss that we booked here has in it a gain associated with the Ford Motor Company stuff. So should we do something with that? Well, not right yet. Not quite yet. Okay? But if that's bothering you right now, know that it's bothering you for the right reason. But we'll look at it later. And then the difference here is just a realized gain on sale, right? 5504, realized gain. Then we're buying some more stock. Amanda Smith Apparel, 4,000 shares, $12.75 a share, plus brokerage commissions, $370. Just like with all other assets, we include all the costs that we incur to get the asset ready for their intended use. This $370 is just going to be wrapped into the cost of the investment. It's not an expense. So we book the investment for how much? $51,370. 4,000 shares times $12.75 plus the brokerage commissions of $370. So that's how it's going to be booked. And then we get to the end of the year, and we have the following fair values. What we need to do now is compare to the cost of the the individual investments. So Amanda Smith was 51,370. General Motors was, go back to the previous page,
63,
63.5. And Kellogg, 28,270. For a total of 143,140. So that means that our securities fair value adjustment account needs to have a balance equal to what? A debit or credit? The debit balance? The debit balance of how much? 12 something.
12,850.
That's 12,850. Debit. And currently we have what?
Currently we have credit balance of 7110.
The credit balance of 7110, so the entry is going to involve a debit or credit to the securities fair value adjustment account, how much?
Debit of 19,960.
The debit of 19,960, very good. For available for sale securities. And then credit, unrealized holding gain, loss, which is owner's equity of 19,960. Now, again, this might make you feel a little uncomfortable because the previous 7110 in the securities fair value adjustment account was based also on Ford Motor stock, and that's now gone. Do we just carry that forward somehow in the securities fair value adjustment account? Yeah, that's what we do. We just carry that forward. Okay? And we'll make our adjustment to the securities fair value adjustment account by simply comparing the beginning balance of this account to the ending balance. Whatever sales and purchases were made during the year, at this point, does not need to affect our computations because this is the true impact on our financial position. Okay, this is the true impact on the financial statement. All right, and we can set that all up again over there, but I don't think we need to. But this is the time to talk about this reclassification. Because if you look at the actual holding gains during the period, what do we have? Or the holding gains rather on the stock portfolio in total. On the stock portfolio. No, I'm sorry, the holding gains during this period. So let's write down here the holding gains / losses. And that's just for this period. Okay? Because I want to talk about this reclassification. So the holding gains and losses for this period. Well, for Amanda Smith, obviously, that is 55,670 minus the 51,370, right? That's what we bought it at this period. That's what it's worth today. So there's a holding gain on that investment of 4,300. Yeah. General Motors, bless you, that's a fair value today of 72,510. At the end of last period, it was 60,800. So the holding gain on that investment this period, the difference between 72,510 and 6,800, does everybody see which numbers we're comparing?
Mhm.
The holding gain in this period is 11,710. 62,510 minus the fair value at the beginning of the year, 60,800. And then Kellogg, today is 27,810. And at the beginning of the period, it was 20,800. Right? So the holding gain on that
7,010.
was 7,010. So that's the holding gain on the securities that we are still currently holding in our portfolio. What's important to recognize that we also had a holding gain this period on the Ford Motor stock. Okay, obviously that was booked as part of the realized gain up there, but the Ford Motor stock had a fair value earlier this year, 57,444, whereas at the beginning of the year, it was 55. Right? So Ford had a gain of 2,444. Does everybody see that? That's the difference between the 57,444 on the date on which we sold it and the 55 that it was worth at the beginning of the year. So the total holding gain in our available for sale investments, if we add these numbers, is really 25,464. Do we agree with that? That's the total holding gain. But what we actually book as part of our gain, unrealized holding gain in equity, is 19,960. How do you reconcile the 25,464 to the 19,960? Subtract the realized gain of 55,004, right? This minus the realized gain from up there of 55,004 brings you to exactly this. So what you would see in OCI, in the disclosure, if the disclosure is detailed enough, you would have other comprehensive income. They would say holding gain or unrealized holding gain. Of 25,404, but then they would say less the realized portion, realized gain of 55,004.
Isn't it 25,464, right? I just want to make sure.
464, yes, sorry, yeah. 464, less the realized gain of 55,004 to report the actual amount of 19,960. Now notice that that is the number already that our journal entry, when we just simply compare what the balance in the securities fair value account should be to what it is, that we already came up with that 19,960. But if you get a detailed disclosure on it in other comprehensive income, it would show it like this. And then this 55,004, where they back out the realized gain, is the reclassification adjustment to avoid a double counting of this number in other comprehensive income and here, because it's right here, of course. So that realized gain will be reported here, and then they subtract it there to avoid double counting, so that unrealized holding gains or losses part of OCI is that 1996. Yeah? Any questions on that?
Pretty much when you sell the security, you're getting that balance out of the OCI. You're pretty much eliminating that balance out from the OCI.
So no, at the time of the sale, you don't need to do anything with OCI. You don't need to do anything with the securities fair value adjustment account. You just need it. You just worry about it at the end of the year. It is only in the disclosure of other comprehensive income that you would need a reclassification adjustment to avoid double counting. But you see that the way we compute this 19,960, we didn't have to do all this. Well, let's compute the actual holding gains and then subtract and realize. We didn't have to do all of this. It just popped right out when we compare what the ending balance should be in the securities fair value adjustment account to what the beginning balance was. This popped right out. Okay? So this is just an issue about the disclosure, is reclassification adjustment. Yeah? All right, any questions? And then, of course, if the investments instead were not classified as available for sale, but as trading securities, how would this change the financial statements? Well, none of this stuff, none of these unrealized holding gains would show up in OCI, they would just show up in net income. That's the only difference. And you make that clear by changing that underscore equity to underscore income. So when you do a journal entry for this stuff, that's the really important thing that I'll be looking for on this. Because where you classify this is really the big story between trading and available for sale securities. Right? Do you put an OCI or not? All right. Yeah, we didn't even need an hour. We did in 15 minutes. Of course, I'm willing to stay for anybody until 4:40. All right. Any questions? Good. So what if you own more than 20%, but less than 50%? More than 50% we're going to consolidate. We won't talk about that in this class. Unless you want to.
I just said thank God.
Really the rule for this method is, the equity method investment approach, is you need to be able to exert significant influence in the company whose stock you own. Okay? So if you own 30% or 40% even, but somebody else owns 60%, you should not use the equity method. Okay? Because you can't exert any influence at all. Right? If the other person owns 60%, yeah, you might own 40%, but they can outvote you every single time. If you own 30% and the rest of the holdings are dispersed, then obviously you're the big kid on the block, right? And you've got a lot to say. So that's really the criteria. And then the way to account for equity method investments is you record it at cost. You always record it at cost, right, when you acquire it. But then we adjust the value of the investment. The value of the investment we adjust not using the fair market value, but we just simply look at increases and decreases in the other company's retained earnings. Okay? So what makes retained earnings change? Well, net income makes it go up and dividends makes it go down. So that's it. When we own another company and we own a significant part of that company, right? The thing really that affects the value of our investment, of course, is when they see changes in their earned capital. Right? That's what changes the value of the income. If they experience changes in contributed capital, does that affect our position really? It doesn't. Right? Because these are other people just putting money in. Sure, the value of that company goes up, the equity claim goes up, but that's because they just issued stock. That doesn't affect us at all. But if that company is being profitable, right, our claim on that company's assets has gone up. Whereas when that company pays out dividends, we're going to get part of it. What does that do to our claim on that company's assets? It goes down, right? So under the equity method, we just simply adjust the value of our investment whenever they report net income and whenever they declare dividends. When they report income, we make it go up. When they pay dividends, we decrease. So let's example here. On January 1st, 2007, Chicago buys 30% of Boston's shares, a total of $800,000. So, debit equity method investment. $800,000 and credit cash. Or long-term investment. Long-term investment, however you call it, that's fine.
You're not just calling it stock because it's over 20%. Otherwise, it'd be hard.
So otherwise it would have been available for sale security, right? Otherwise it would have been listed as available for sale security. Now, you can choose to disclose this as an available for sale investment. Even though you own more than 20%, you don't have to use this method. You can use the fair value method and classify this an available for sale security. Okay? Available for sale securities can be also strategic investments that you plan to hold for the long term. This used to be mandated that you would use the equity method for investments where you have significant influence. These days, you can choose to use mark-to-market accounting for these investments also.
Debit or commons. So that's an asset. Okay.
Equity method investment?
Yep.
Yes. Long-term asset. Long-term asset. You can call it investment. Long-term investment. That's fine. All right. The thing that happens here when the other company reports income, normally when you own, right, when we classify this as an available for sale security and the company in which we're invested reports income, you hope it's high, but that doesn't mean anything to you, right? At least not from an accounting standpoint. But here we say, look, we own 30% of this company, so we really can claim 30% of their income. So we're going to take 30% of this 270,000, that's 81,000, and we're going to book that as an increase in the value of our investment. So we're going to increase our investment by 30% of their net income, because hey, that's ours. And then we credit what?
Kind of an equity account.
Some kind of equity. Is it earned capital? Right, so that's always the way to think about it. I agree, it's got to be an equity account. So is it contributed capital or earned capital?
Earned capital, net income.
It's earned capital. It's part of net income. Absolutely. It's income. Income. Investment income.
Oh. Nice. Good job,
Can't
Sean.
leave on that note.
That Sean was like, hey, why are you guys calling? So this is going to be booked as income. This will just be part of our net income. Okay, other income. It will be in the other category. Other category. And then when Boston declares a dividend, so on January 20th, they declare dividends of $20,000. Debit investment income.
Debit cash.
Well, they declared it because of
Oh.
Debit dividends receivable. They just declared the
I
dividends,
see.
so it would have been debit cash if they'd gotten it, but here it's just debit dividends receivable, bless you. For 6,000, right? 30% of 20. Debit dividend receivable for 6,000, and credit, exactly, credit the investment. So following the same logic,
Wait,
when they pay out a dividend, my claim when the company's assets goes down,
20%, 30% of 20,000.
30% of 20,000, $6,000.
What entry will the subsidiary make on the 81,000?
Debit dividends, credit, on the 81,000, no entry at all. I mean, that's just their net income, they report the net income. There's no entry that they make, right? They just announce their annual profits. They say, hey, our profits 2007 are $270,000.
And they're paying taxes on that income, and then we're paying taxes on a portion of that income too.
So how this works from a tax standpoint, I don't know. No, I'm pretty sure these are not going to be taxed twice. The dividend distribution is going to be taxed twice, right? Or the dividends are going to be taxed.
capital gains.
So I don't know if the IRS uses the equity method. Probably not. The IRS is probably just going to say when you receive a dividend, you're going to have to include that in your income, and we're going to tax you. The IRS is not going to tax this.
But that next year could be wiped out anyway. And not until you finally realize it, will you be taxed.
So they're probably going to tax this. But notice that the dividend receipt does nothing to Chicago's earnings. Right? When they receive the dividend, of course, it's just going to be debit cash, credit dividend receivable for that $6,000. So ultimately, if you consider these two journal entries together, how does the dividend payment affect us? Right? So we're invested 30% in Boston. They pay us $6,000 in dividends. It just decreases my investment and increases my cash. Right? Which makes a lot of sense, because what is it when a company that you own pays you a dividend? That's just really moving money from this pocket to that pocket, right? That's all. Instead of it being in the investment, it's now my wallet. They either have it to do stuff with, or if they're going to give it to me, then it's in my wallet, fine. But that didn't do really anything to change the financial position of me. And that's captured here. It's just one asset goes up, the other asset goes down. I've got more cash in my wallet, but the value of my investment has gone down because I withdrew it from that investment, if you will. It's almost like a bank. So that's the equity method. Goes up by the amount of net income, goes down by dividends. Obviously, if you incurred a loss, or if the other company incurred a loss, that would also decrease the value of your investment. Okay? Now, if they incur that many losses that your equity, that your investment is recorded at zero, you don't go down below zero. Okay? So it could happen that using this method, you write down the investment all the way to zero. If the losses are so large that your share of the losses has wiped out the entire cost of the investment. If that's the case, you stop using the equity method. Okay? You don't keep going and record a negative investment value. Because of limited liability, right? Can't be less than zero. Can't be less than zero. Any questions about the equity method? All right, and then there's just one final page on the presentation in the financial statement. So, trading on available for sale securities, They should be accounted as we showed here, right? I removed it in blue. The value that's going to be reported is the 48.5. It's the aggregate value. Okay, that's what's going to be shown on the balance sheet, the fair market value. Trade securities should always be classified as current. Held to maturity and available for sale can be either. In the footnotes, you would describe fair value of the unrealized holding gains and losses, as well as information about amortized costs for investments in debt securities. Some obvious disclosures on equity method investments, you know, how much do you own, what company do you own, fair value disclosures. You have the fair value option. You can choose to account for this at fair value instead of using the equity method. Then you would disclose the security fair value. I'm sorry, as an available for sale security. You need to look to see if your investments are impaired based on a fair value test. If that's the case, then you just write it down. So that's a little bit different than just marking to market, because you will actually write down the cost basis in that case of the investment. Right? You don't do that through the securities fair value adjustment account. You actually write down the cost basis. So you would adjust the available for sale securities. And then if you're going to and that loss, the impairment will be part of regular income, of course. And then if you're going to transfer between categories, so you change from trading to available for sale or from held to maturity to whatever. This tells you how to account for the unrealized gains or losses. So whenever you move between trading and something else, so it was trading and you go to something else, the unrealized holding gains and losses are going to have to be booked in income because you weren't trading to begin with. Reporting owner's equity for transfers between available for sale and held to maturity. For the other way around, again in income. All right, those are just some details. Good news on those details is they will be part of the take-home quiz, not the final. So no need to take a dive of memory space trying to remember those details.
And when are you going to give us that question?
I will send it to you.
As soon as possible?
Sure. Tomorrow?
We just have a lot going on in the next couple of, so we need to.
The more time the better.
Yeah, more time the better.
So that you can budget it as well as possible. Okay. Yeah, I'll send it tomorrow. If I haven't, please send me a reminder email. So if by tomorrow night I haven't sent it, I'm sloppy. I will remember.
Can I just send that email now?
No, because then I'll still feel like I've got until tomorrow.
Okay.
You have my
I want to check off my list.
Tomorrow morning?
I do.
Let me try to do it tonight. How about that? See if I can squeeze it in between a haircut and buying my wife a card and some chocolates and rushing home and all of that. All right, any other questions? Then, happy Valentine's Day. Drive safely. And I'll see you guys in 2 weeks, but you'll hear from me perhaps tonight, but certainly tomorrow. If not in the morning, then after Robin's prompting in the afternoon. Does Erica